Live from the Millennium Falcon, this is the first ever edition of the Nerdy Mortgage Guy, and these are the 10 ways to avoid mortgage disaster. Yes, R2, I'm telling them. Stop. Welcome back to the first ever post for the Nerdy Mortgage Guy. So today we're going to talk about the 10 ways to avoid mortgage disaster. Well, some of the 10 ways. Sometimes there's a lot more. Number 1, don't quit your job. So I'm going to make this very brief. We are going to call and verify that you still work at your job the day of closing sometimes to make sure that you still work at the place you told us when you qualified that loan. I know this sounds crazy and this sounds really dumb, but I'm going to tell you this has actually happened, and closing papers have actually been removed, and that person did not get a house because they quit their job that morning and didn't think we'd find out. So, biggest rule, don't quit your job because that's the income you use to buy the house. Item number 2, don't move a bunch of money around in your bank account. Now, what I mean by that is don't be transferring things from someone else's account, your girlfriend's account, your wife's separate account, your 401k. Just don't move a bunch of money around. It causes too many questions, and it looks like there's some kind of money laundering thing going on. So here's the simple thing. If you are going to buy a house, it's nice to actually have a house account. So what I mean is like a savings account or some other kind of like fund, like at a savings account at a different place where you actually have your money always in that spot. Now, we're going to look for 2 monthly bank statements. So that's going to be seasoned funds, right? They've been sitting there, they've been sourced, they're ready. So I fully advise having the money put in the account, and when you're ready, just kind of have it there and available, and don't move a bunch of money into that account for a couple months because it's going to make the process a lot simpler, less documentation, less questions. Simple, easy, much better. You're going to make this process happy, not a headache, because it can be. Item number 3, don't buy at your maximum purchase price. When I say that, it's because we don't want you to be house poor. When you actually look at your finances and you look at what you qualify for a loan, you may qualify for up to a $250,000 house with 3% down, whatever it is, and a payment of $1,500 a month. But when you actually sit down and drill at the numbers, you got to realize one thing. We aren't counting things like your utilities. We're not counting your Netflix, your cable. We're not counting water, sewer. We're not counting your dining out habits, your wanting to travel habits, anything like that, car maintenance. There's a lot of things that are not taken into account when it comes to the actual mortgage payment itself and the debts that we're using to qualify you for the loan. We're using things like your cars, your credit cards, your student loans, those kinds of things, secured lines of debt. Those are the items that are going to pop up that we actually use against your credit. Now, if you're doing a VA loan, we are going to consider things like how many people are in your house, the size of the house with the utility, and we are going to look at your daycare cost. But other than that, the other loan programs, we're really not looking at those things. So you really need to sit down with either your mortgage lender, financial advisor, or yourself, and somebody that can sit there and explain to you, here's your finances, here's your income, here's your potential expenses, here's what the house payment would look like. Now, where you're going to be comfortable at is kind of up to you, and what you qualify at may be higher than what maybe you're comfortable going, but that's something that you guys need to have that conversation. So again, don't buy what your maximum purchase price is if you can, because you might end up making yourself house poor, and that's not a life you want to live. Item number 4, ask for loan options. Now, the reason I say that is everybody thinks, oh, I got FHA, I got conventional, I got VA, I got USDA, 20% down, 3.5% down, 0% down, no P. Look, there are a lot of loan options out there in this world, and there's a lot of things that people just don't even think to put you into because they don't ask the questions, or they just assume, oh, I'm putting 20% down, my credit score is 740 plus, you're just going conventional all the way and this and that. Well, there may be other things that you would feel better doing. Maybe you're only going to be in this house for 3 or 4 years, like that's your plan. And you're going to be out because you're going to either transfer for work, you're going to have a kid, you're going to want to upsize, and maybe a 5-year ARM or a 7-year ARM that's offering maybe a quarter or a 3/8% better interest rate would be a better fit for you because you're actually going to be out of that house before that ARM ever really adjusts to a higher interest rate. that's an instance where that could be a better product for you. There's other things like an all-in-one loan, which we'll do a video about shortly, where maybe your goal is to just pay off your mortgage and you plan on being in this house for a long time. Maybe you're a senior and maybe doing a reverse mortgage is better for you. Until you actually sit down, look at all the available options that are actually available to you that you would qualify for, I don't think you're actually getting the best advice or the best service if your lender isn't doing that for you. There are so many different ways to make these mortgages work for you financially, maybe ways to avoid PMI, to have lesser PMI, again, Home Possible, Home Ready. I could literally go on forever about all the amazing products that are available to you, but you really need to ask, and you need to sit down, and you need to tell your loan officer or your lender, whoever you're working with, what your goals are in the future. And if that lender isn't asking those questions, then shame on them, because they really need to get to know what it is that's driving you in this purchase. So again, ask for loan options whenever you go through the loan process. Item number 5, get started early. Now you're going to kind of see in the next couple points that this is actually going to be a recurring theme. So when I say get started early, that means you need to actually have some paperwork together. You need to have a conversation together with a lender before you even go to start looking at houses. Yes, looking on Zillow, Realtor.com, your agent's Maris site that they're sending you with a list of homes that you like. That stuff's great. But you also got to realize a lot of agents, they aren't even going to show you any houses in person unless you actually have a pre-qualification or pre-approval letter. Now there's a difference between those two, which we can do in another video. But the thing is very important, and the way you get that is you get started early. You meet with a lender, you figure out, again, what you should buy, what your loan options are, and you actually figure out what your max purchase price that you'll be comfortable going at is. And if you have all of that together up front, it's going to make the process so much smoother because you've allowed yourself the time to kind of get into the mortgage process before you start looking at homes, rather than getting under contract and then trying to shop around for 30 days and causing a bunch of stress on yourself with appraisals and inspections. And it's a headache. Do that process first. Get started early. Get pre-approved if you can, which again we'll do another video about first, or you can Google the difference between pre-qualification and pre-approval. But those are the biggest things. Get started early. Okay. Item number 6, self-employed. That's not really a mortgage disaster, but it can be. And I'm going to explain why. So again, I told you that item number 5 was going to become a recurring theme over the next several points. When you're self-employed, you need to get started early. And the reason why is the documentation that we're probably going to need for self-employed is a little bit higher than what you're going to need if you're just a W-2, straight up salary type employee or hourly. Because one, your income history might be sporadic. You may have really increased your jobs. We may only need 1 year's business tax returns, or we may need 2. It depends on what our findings actually tell us in our automated underwriting systems. So there's a lot of things that could come into your benefit, to your not benefit. Let's say, for instance, perfect example of income. Let's say that in 2017 you made $100,000, and then in 2018 you made $190,000. You're thinking to yourself, well, surely they're going to look at my income. I made $190,000 last year. That's my income. Well, no, we're actually going to be taking an average if we need 2 years returns between the 190 and the 100, because that's your income history. That's the stability, right? So it's closer to that $145,000 a year. Whereas if let's flip it. Let's say you made $190 in 2017, but you only made $100 in 2018. Well, with self-employed income, we actually have to use the lesser of those two things, because that is the most recent income history that you were given to us. You can't use the declining income, like that's the declining income, that's what you got to use. If you're more than halfway through the year, we're going to have to get a P&L. There's a lot of things documentation-wise that we need to do. If you own more than 25% of your business, we're going to have to get business tax returns. Potentially we're going to have to get K-1s if there's distributions. Like, there's a lot of things that we're going to have to do. So you need to get started early, sit down with the lender, and actually understand all the documentation, what your income is, and all those things before you go out shopping. Because we can actually take that information, get it to an underwriter, and actually verify what we can and cannot use and go forward. So that way you shop with confidence. And that is important, because nobody wants that headache at the end of the day. Item number 7, down payment assistance. Again, not really a mortgage disaster, but it goes back to item number 5 about getting started early. Why do I say getting started early with down payment assistance? The The reason that I bring that up is because a lot of these programs, one, have some caveats and catches that you really need to be aware of. Not all of them, but some of them do. They also sometimes require more documentation. Sometimes they require more inspections. Sometimes they require homeownership counseling that you actually have to go and attend or do a class online. There's a lot of things about these programs that may or may not affect your process. And if you are just starting it and you've got 30 days to close, it may take you every bit of 26 days to actually complete all the items that they need, just depending on timing. So if you get started early with these down payment programs, it's going to be way more beneficial to you because, one, you're going to know what they require, you're going to know the things that they need done, you're probably going to have them done, you're going to have all the necessary paperwork that they want, and you can also ask a lot of questions like, are you going to put a lien on my house for giving me this money? How many years is that going to be? Is it forgivable? Is it 0% interest? Like, you really need to understand what it is you're getting. Money, for the most part, is not free. So it's either going to come in the form of a lien, maybe higher fees on the origination side with lender fees. You just don't know until you actually get in there and ask the questions. So again, back to number 5. Get started early. Knowing is half the battle. I think there's a G.I. Joe here somewhere that's about to pop up. I don't know, maybe you're reading Rainbow. Item number 8, have reserves. Now, you're probably thinking to yourself, what do you mean by reserves? What does that mean to me? So reserves means that you are going to have money left over in your account or in a retirement fund after you've spent all the money you need for cash to close. Meaning you had $20,000 total for down payment, closing costs, et cetera, to complete your mortgage transaction when you get to the closing table. Now, if you have $20,000 in the bank and you need $20,000 to complete your transaction, you have $0 in reserves. Again, that could be harmful for some programs. Do all loan programs require reserves? No, they don't. Not all loan programs require reserves, but some do. And sometimes it could mean the make or break of actually getting a loan. Believe me, I've seen this happen. So what I like to tell people is it's actually good to have some months built up. It doesn't matter if the loan program requires it or not. Because think about it this way. What if you lose your job 2 days after you close on this house and you spent all your money buying that house? You have no money to make that next mortgage payment, to make the utilities, to pay any kind of expenses. But if you've got a reserve fund set up, maybe 6 to 10 months worth of reserves, you're going to be actually sitting there with the ability to withstand those hardships while you go out and find new employment. So regardless of the loan program requiring it or not, having reserves is just a very good financial decision for you in your future, so you can withstand things. I mean, again, you're going to be a homeowner. You may need to replace that air conditioner. You may need to do roof work. You may need to replace carpet. You may want to replace carpet, and now you have money to do so. So again, having reserves, just a good, sound financial choice on your half when you go to actually make an offer on a house. So when you talk to a lender, maybe figure out how much you have left. Item number 9, getting close to the end here. Get your documentation together before you actually go meet your lender. Now, you may say, I have no idea what my lender is going to want from me, or what I even should bring if I've never met my lender or talked to him, or maybe I just got referred. So here's the general rule of thumb when it comes to documentation. Big things to have. Your last 30 days worth of pay stubs, your last 2 years of W-2s, your last 2 years of tax returns. It's just good to have them. You may not need them, but it's good to have them ready if you do. If you're self-employed, you're going to need those business tax returns. If you own more than 25% or more of that business, you're going to need your K-1s, the 2 years for both of them, and you're going to need 2 monthly bank statements, and you're going to need 2 monthly or 1 quarterly statement for your retirement accounts or anything like that you might use for reserves, and a copy of your driver's license, just to make sure that we're all following the Patriot Act and verifying who people are. So also, to kind of reiterate about the 2 monthly statements and the tax returns and things like that, look, if a page is blank and you think you don't need it, you need it. If that thing says page 1 of 4 and you only give me pages 1, 2, and 3, I need page 4. These are going to be like the little things that nitpick you and headache you like later on in the process. Like if a loan officer doesn't see that, submits the file, and then an underwriter's like, well, where's page 4? And you've been having it for 2 weeks. So the biggest thing is sitting there. I don't care if it's blank, if whatever it is, all pages, even if blank, all schedules from your tax returns for your federal, you need to have those things up front. So don't try to hide anything, and don't feel like you're saving us, time by not giving us the blank pages, because we're going to need them and then we're going to annoy you for them, and it creates a frustration that is unnecessary. So all pages, even if blank. Just remember that when you go to get your stuff together. Item number 10. This is last, but it is certainly not least. Read my lips, no new debt. And the reason being is, as we go through this mortgage process, we are going to pull your credit report when we go do that pre-qualification or that pre-approval, and we're going to issue those terms based on the credit and the income and the debts and everything that day. Now, as we get closer to closing and things kind of go along, we do have that credit, we have that report that we're going to use, but we're going to do something called a credit refresh down the line. What is that going to do for me? Well, let's say that you actually go out and your credit card was paid off at the time that we started this loan application. Now we're 8 days away from closing, and you decided to go put a bunch of furniture and maybe a stove and all these things on your credit card, and now maybe your payment is being reflected on your debt where it wasn't before. Now let's say that kicks you out of that loan program or even denies you from that loan in general. These are the biggest rules you need to remember when you talk about debt and in the mortgage process. One, generally, don't take out any until you're done. But if you need to, car breaks down, maybe there's a great sale on an appliance and you just have to get it with that 0% APR. First things first, call your lender, communicate, tell them, hey, look, this happened, I had to get rid of this car, I know it was paid off, but I had to get a new car. Do you know by chance what my monthly payment minimum should be or maximum, so that way I can still get this house? Because everybody still has to have a car and drive. So the biggest thing is just communicate and talk and make sure that everybody is aware of what's going on so we can plan for it, we can structure for it, we can make sure that the underwriter knows about it. It's all about communicating. So don't take out any debt, but if you have to, just give us a call. Let us know what you're doing. Well, that does it for this week's installment of The Nerdy Mortgage Guy. I have been your host, Chris Gassel. I would really appreciate a like, a comment, a share, anything like that as I continue to grow this brand and this channel and educate the masses on what it takes to get a mortgage in our crazy world. If you have any topics or anything like that, feel free to shoot me an email. My information is going to be next. Also, you can hit the about, and my information is all there. You can also leave comments below. Definitely let me know any kind of topics in particular that you would like me to talk about. I'm an open book, and I'm here to educate. So look forward to giving you guys that next one. Have a great day, and we'll see you soon.